Hello, this is Pat O'Mara. I'm with Albert Burdellins here with me at Invenium, and we're excited to be talking with Stephen and David about the professionalization of real-world asset administration, or as some people say, democratization from a DeFi world, or professionalization or retailization, excuse me, in the TradFi world, and understanding how the administration of these alternatives are going to drive a broader distribution opportunity. And so we're super excited, David and Stephen, to have you guys. And David, you've been here a couple times. You want to start with just a quick introduction of yourself and Houlihan Lokey?
Sure. Houlihan Lokey, a very large investment bank, publicly traded, three major pillars: corporate finance, financial restructuring, and an evaluation and advisory business, which is where I sit. And my background is complex derivatives, trading, running trading and banking businesses, particularly in the U.S. And I've been fascinated to watch the progress of both Invenium and these disruptive new technologies, because from my experience in the traditional finance world, we need some disruption. We need to change the way that we look at private market assets, and make them feel like public markets. Not be public markets, but feel like public markets. And that's one of the things I want to talk about today.
Yeah, and feel like, in the sense of, have some of those characteristics of functionality,
Yes.
Right? And there's going to be distinctions there, but what is that functionality we're going to look for? And Houlihan Lokey, you guys are clearly one of the largest valuation and appraisers, fairness opinion providers for private market assets, and this really is your business, right?
Exactly. This is right down the middle of the road for us. We look at a huge number of assets. Our exposure is to a very large number of all of the large asset managers, and we see across the entire space that retailization is important, frequency of marks is important, liquidity of their investors are all important features, but the infrastructure is not there to support it.
Fantastic. And we've been working with Houlihan Lokey for a while. We're super excited to have you. Stephen, we're excited to have you. We Invenium, in full disclosure, we have a relationship with Hedgehog. We're super excited to be working with you guys as well. Stephen, you came out, before Hedgehog, you came out of complex assets, right, at Partners Group. Tell us a little bit about Hedgehog, and then tell us a little bit about yourself.
Spot on. So at Hedgehog, we're hoping to become part of that, financial market infrastructure that helps this retailization of private markets. So a little bit about me, background is I'm a lawyer. I started out in private practice working on fund formation, etc., for some of the largest managers in Europe. I then moved into Partners Group. I'm based here in Zurich at the minute. And I spent 4 years doing a little bit of everything there. So, commingled funds, mandates, subscription lines, etc. But what I really got nose deep into was complex products. So really structuring products for retail across the US, Europe, and Asia. And that's when we sort of realized there's a big demand within private wealth for private markets products, but the infrastructure isn't there for it to bridge that gap to facilitate that investment. And there's no one really in the market that's correctly addressing it. There's not one probably single provider that can address it, because there's a lot of systemic problems to tackle. But there's a big macro trend towards that, and there needs to be a tech sort of level to address that demand. So that's where we come in at Hedgehog. I've been here like 2 years. I'm head of structuring. So what we're doing is trying to work with, Pat, as you said, providers like Invenium with that data layer. We're trying to build solutions using blockchain technology that bridges that gap. So large distribution partners, small distribution partners, etc., can then tap into investment products offered by these, blue chip type of private equity houses. So we go across all the different asset classes, infrastructure, private equity, real estate, credit, etc. And aside from providing that software and tech as a service, we also provide the consultancy to these larger managers about how they might want to set up, structure these assets and funds, etc.
Yeah, one of the reasons we are excited to work with you guys at Hedgehog, we were actually introduced to you by a mutual client, right, who asked us to partner. And what a great introduction. And you have such a competent team that works with you, alongside you, and Rob and Michael and Django, the whole team. We've just been so impressed, and you guys are really building some stuff that is going to move the needle. So thanks for coming and joining us.
No, likewise, Pat, it's mutual. Yeah, like that's what I mean. As soon as we had that first initial meeting, with that mutual client, it was really clear, where these building blocks click together, the synergies. And then once you dig a little bit deeper after those initial meetings and start bringing proof of concepts to the table, and then you start to see, where efficiencies can be made, cost savings, time savings, etc. So excited to really, deep dive into these in this call today.
Fantastic. And Albert, it's great to have you as well. I think folks who've been on our platform and have watched the podcast, they've gotten to know you as our head of AI, but also you really lead our interactions with a lot of our large tech providers, right? And you manage those relationships. Why don't you talk to us for a little bit about that and kind of the role that you play?
Sure. So, like you said, my name's Albert Berdellens. I lead the AI division at Venium, which turns out to be kind of a purchasing department of setting up these partnerships with all the large-scale AI providers, because our platform, as it turns out, is a perfect solution to provide compute-ready data on a turnkey basis for enterprise, which has been an exciting kind of development in the marketplace. But in that capacity, I end up doing two side jobs, which is as a translator and a diplomat. Translator because I have to translate finance industry jargon to tech industry jargon, which is more than a little challenging. And then diplomacy, trying to negotiate armistices and ceasefires between crypto anarchists and TradFi conservatives. So it's an exciting role, and I'm really looking forward to the discussion today. I think that gave a good preview.
Yeah, I'm going to add one more thing, Albert, to what you've talked about, which is, and we've talked about this previously. Half of your day, you say, is spent talking people out of using AI or blockchain for one thing, and then talking it into another, right? And because AI and blockchain are not a panacea, they don't solve every problem, but they do have very real function that can facilitate the better administration of data-rich, low-frequency trading assets, right? That's the solution. And I think when we talk about retailization, David, what we're talking about is right now on private market assets, we turn the crank on the data once a quarter, right? Maybe we turn the crank on that data once a year, right? But that turning the crank is literally, what's the value of the asset? What's the waterfall? What's the carry calculation? How do we allocate expense? Value the capital stack inside that asset, allocate that towards a portfolio, right? And then value the portfolio. And we turn that crank once, maybe once a year, maybe once a quarter, deliver that to people. But the issue is we want to start turning that crank every day, right? Now, There's not enough data points to move the needle every day, but across an entire portfolio of 50, how do we monitor that data without creating the world's largest database in the middle, right? Which is what Invenium does, right? But how do we begin to turn that crank and automate this? And there's machine learning, there's robotic process automation, there's workflows, there's blockchain, there's AI taking unstructured to structured. And the solution here is not one. It's the convergence of a number of technologies to solve a problem that have meaningful effects. And I really would love for you to talk about within Houlihan Lokey and what you're doing and what your clients want. Yeah. Talk to us about this retailization and how do you guys think about this problem?
Okay, good. Well, as long as you have an hour, I'll work through this for you. But so let me start on the client end for a second, because you're right. Our clients, large asset managers, are saying they could increase AUM and fees proportionally with products that go to retail. Retail demands frequency of marks. Now, maybe it's not daily, but once you start looking at these processes, you might as well do it daily, because someone has to responsibly bridge the annual or quarterly fundamental information changes with the daily price changes. And valuation agents, besides Houlihan, are looking at this issue and how do we do this? And one of the ways to do it is to marry what's going on in public markets, like indices, with what's going on in private markets. But the trick, as you said, is to make sure that you've actually got no new material information in that fundamental analysis. I can't just assume every day that nothing new happened in that company until the end of the year when I redo the fundamental analysis. So I also need a monitoring system. So in addition to bringing in sort of index type information from public markets, I need a monitoring system to make sure, geez, that company didn't blow up, it didn't lose a major contract, it didn't have some significant issue, or something going on in the public markets has a real correlation to what's going on in that private company. So those things have to be monitored on the side so that we don't blindly simply assume that there's this static information that's going to just fundamentally change once a year. Building that system has been far too complex, either far too manual, you need a ton of people doing research, whatever it is. It's always been too people driven. But now we have an ability to use a good, and I don't even call it a good data set, but a provider like Invenium of access to a data set, and LLMs and some other ways of monitoring news in the market, so that we can now tie these two things together much better. And these are technologies that are just developing in the last 6 and 12 months. They're not institutional yet, but that process, if I get back to the process for a second, requires that we are able to, and we have a number of clients, particularly those that have publicly traded vehicles that are owning these private assets. We have systems that will daily mark private assets. And when we do that, we need to take all of that fundamental information, keep it available, and decide which pieces are relevant. And when I say which pieces are relevant, which inputs to that process are relevant. And I had one of those hallway discussions on Monday afternoon or Tuesday morning when we saw the public markets gyrate. And so the question was, okay, we've just done our quarter end marks. We have these big gyrations in public equities, right? How are our clients supposed to feel who are marking their private assets when the public markets are swinging so wildly? I don't have a good answer to that yet, but what I do know is that it needs to be reflected. And part of what has to happen here is we have to be able to say, was there fundamental reason for that public market price gyration? Does it affect these private companies in the way that we need to change our fundamental analysis? And that loop is where I know at Houlihan Lokey, that's what we're working on. How do we make sure that we're not missing important pieces?
And that loop, right, where you're pulling the data, feeding your very complex systems to value. And when I say very complex systems, I mean big Excel with macros, right? And in some cases it's something more than that, but in most of the private markets, yes, that's it, right? Yep. And it's an AVM that you're using, that you're updating. And the question is, there's a qualitative question: how do I find the signal in the noise with the information that actually is going to touch this, right? And there's a lot of noise out there in the public markets, and this mechanism where when you can start to use AI with context and attribution and trust, and you take unstructured data that lives everywhere, you structure it, start feeding it into here. We start getting these daily marks, it's feeding the AVMs, right? That you got a third party mark once a month on every single asset, but then the AVM is revaluing that portfolio every day. Suddenly you have a whole new set of data that you need to consider. And the reality is some of the public pension plans don't want that data, because what it really means is when they think that their risk that they're measuring on their private portfolios, that it doesn't have the swings in the market, right? We can give all sorts of technical names to that, right? But those swings in the market, if they actually understood the actual risk, not the reported risk, the actual risk, because when those public companies get hit, that real reflection of the price in the market, they actually have more cash on hand on average than the private companies do. Yeah. The private companies are actually facing the squeeze at a much greater rate than they are, and that ought to affect them. And
our observation of private credit is that there's an enormous number. I think it's half of the companies we look at have a fixed charge coverage of between 1 and 1.3 right now. That's a lot of leverage. That's not much cash and a lot of leverage.
Yeah, that's right. Yes. And the concept around how if we start to really show the beta, right, and we start to show the risk, right, and what's happening, they're going to be forced out of the highest returning asset classes. So they want to underreport. Do you know what I mean? And the vested interest to underreport, or the data asymmetry that people are using, and that market dynamics are fighting against, Stephen, what you talked about, which is for the macro, they don't want that, but they know for the micro, in order to unitize, in order to retailize, in order to democratize, they need to feed that, right? For those complex assets, they need this reporting real time.
Oh, completely. Like, especially whenever we think about, private equity today, private markets today, it's been sort of stagnant since its inception. It's been dominated by institutions. Everything's a pretty much manual process. We hear a lot of the term like operational excellence thrown around now, and this is firms basically, integrating tech into themselves instead of, Pat, as you just said, an Excel sheet, etc. Whenever we think about retailization of these same products, what we started to notice was, institutions are there in perpetuity. They're not going to die at a certain age. They don't get, divorced. Like, they don't have these life events that happen that they need like more liquidity, etc. And that's why these valuations and getting those data points together is super important. Now, as you said, Pat, like getting that unstructured data, using AI to pull that together, make it structured. Taking this digital thumbprint, a hash, putting it on chain, maybe that you can then verify that data, use that data to perform like a waterfall calculation, perform a strike for the mark price or whatever. It's all super important whenever it comes to retailization. Why? Because they want more liquidity. Even like a simple fund with like a 10-year lockup, etc., which we have in Europe. Like we have an LTIF structure that came out in 2015, 2016. I worked on the first two with Partners Group. And all these guys were super interested in getting it, but they were like, hey, look, a 10+2 structure is great. Like, a minimum investment of 10,000, like all my, doctor, lawyer clients, they can now get access to private markets. But guess what? We need liquidity. And you can't really get liquidity in these products because you're striking a quarterly, a semi-annual, or an annual valuation with an individual with maybe a small holding. Is there a secondary market for your holding with other individuals if the market isn't that big? So like, there is a real knock-on effect between getting this data, like, in the ether where it is now and putting it together, and then the downstream benefits that you're going to see. It's going to actually facilitate more AUM coming into these products and these managers, and marrying, the private wealth and the private markets together the way, like, everyone's talking about now, but no one's talking about, what needs to glue those two things together.
And it's the administration of the assets, the data from the assets, pulling the data from the edge, proving, origin of data, proving state of data, proving process of data through that valuation of the underlying asset, the waterfall, the carry, the valuation, you set the mark. And then that can then start to flow into these structures such as these perpetual future contracts, right? That Schiller created. And then you can create these mechanisms for people to come in and out of structures, automatic market making. Because if you demand a market maker on something thinly traded, it won't happen. The people they're not going to store capital there, right? And so the idea, they're not going to park capital there in something that's not going to move. So how do you facilitate this that allows this movement in and out in an orderly manner where a single buy or a single sell won't move the market, but where you can literally start to aggregate this orderly market? And that's the functionality where, for us to turn the crank right now, NAV, waterfall, carry, value the NAV, typically that might be 3 or 4 different groups. And each one does the previous guy's work to make sure it was right. So if we can automate that with the data flows through, look for deviation, and what took 3 weeks or took 3 months can take seconds. You know what I mean? Where we're feeding this, and then all of a sudden we can market, and then a human being provides QA and sanity check. You know what I mean? And then literally we can say, okay, we got a mark for today. And this is what Refinitiv used to do, where all the information would come from New York over to the Netherlands, whatever. They would mark it up, ship it back before the market would open. We can do that all manually if we can gain access to the data at the edge, but trust the data. And this is where AI comes in, right, Albert? Because one of the things when you do any form of automation, if you have automation without attribution of where the data came from, and you can't double click it and you can't audit it, that automation is really, it's window dressing. It's not meaningful. You know what I mean? A human still has to redo everything.
Yeah. So what's interesting is, you have this giant range in this industry when it comes to real world asset administration. You have the, tokenization maximalists on one side, where, oh, we created a token, it represents a share of this particular asset because I said so. It's worth whatever amount I say it's worth. If you don't want to buy it, don't buy it. Do your own research, buyer beware. That's on one side. On the other side, you have, a large portion of the TradFi industry that as soon as you say the word blockchain, their eyes glaze over. If you don't have a minimum of $100,000, you might as well not exist. The whole industry making money on the arbitrage and inefficiencies of traditional finance. So in the middle, you have us reaching out to both sides, bridging the gap and saying, you need to professionalize a little bit. Tokenization maximalist, that's not good enough. You can't just offer, securities to retail investors for whatever you want with no information. And then on the other side, hey, dinosaurs, get out of the way of the meteor. It's coming to hit you. And so we do a lot of work, to get data to people who need it for technologies that are really at the cutting edge and getting them to enter the real world and how it works. And then on the other side, getting people who have very successful businesses to see the future on the horizon coming towards them and adapt and get it ready accordingly, and making both of those processes as easy as possible for them.
And I think that creating pools of capital quickly in a decentralized manner, DeFi, DAOs, things like that, where it doesn't need to be organized in one Uber bank, right? And Jamie Dimon, in 2019, was saying that these DAOs, when they were explained to him, he said, the future of a bank might be a series of DAOs against specific types of assets that are going to be managed. And I was like, ooh, that's a pretty prescient thing, as he began to understand what it was. And that this reality is, and when you just describe the two ends, and forgive me for all the viewers who are doing this, but I have a 15-year-old son, and for those of you who've seen kind of Napoleon Dynamite, right? When he goes to the Taekwondo, Rex Kwon-Do, and my 15-year-old boys right now, like as they're quoting them, right? Nobody wants to get kicked in the face with somebody wearing pants like these, right? That's how TradFi looks at blockchain, right? Like, oh, I'm gonna kick you in the face. Thank you very much, right? Like you just go sit in the corner. But then they're missing, and I think that extreme is this guy who's been turned into a caricature. You know what I mean? Literally a caricature of what can really happen. And it is marrying the very complex administration of assets and funds on a high velocity, not turning the crank once a quarter, turning the crank every day, right? And then what is the AVM? And we're going to need an ecosystem to do this, because we need Houlihan Lokey and JLL and CBRE and whoever else that's there, Baker Tilly, McKinsey. They're going to come in and say, listen, this is the model. Green Street, and I'm forgetting a whole bunch of others. I apologize to all of you, right? Here's the model we're going to use, and here's the way that we're going to find the signal in the noise about how to update the AVM from the daily movement of the broader markets, right? And we're getting this real-time information once a month, once a quarter from the buildings. But, Microsoft, which trades every day, Amazon, which trades every day, they only publish their underlying information once a quarter, you know what I mean? Or when there's a material event. But people are correlating market data to infrequent company response. Private markets are going to get to the point where we're delivering real company or asset level data more frequently than public data, and more reliably and with better audits. Does that make sense? But we need that correlation function and to understand this administration, because the difference is every single real estate deal is done differently. Do you know what I mean? And that capital flow in what's in the portfolio is done differently. And then the managers administering that. And I'm going to go to you, Stephen. Talk to us a little bit about the complexity of just turning these things into retail operations, and where are those touch points where we're going to see automation take over?
Yeah. So again, like David said earlier, I could talk to this point until the cows come home. First of all, just what you said on blockchain completely resonates with me. Coming from like a TradFi background, working in alternatives, whenever I first came across blockchain, I was like, yeah, all these guys are like, blockchain is going to take over the world. And you sort of discredit everything about it. Then I got into Hedgehog, and we were by no means blockchain evangelists. We come from a finance perspective and then work back as to, what's the best technology application to address these problems. So we start with the problem, then look at the solution. Whereas I think a lot of blockchain, works the opposite way. Here's a solution, looking for a problem. And so yeah, we come at this the same way, that blockchain is an inevitable part of the financial infrastructure going forward, but it needs to be married with that, all this data coming together in order to, advance these processes and advance the market. Coming on to what you just asked, Pat, about the administration hurdles that we'll face. One of the key things about that data you just talked about and marrying that with blockchain is standardization. As you said, every real world asset has a different sort of methodology for being valued or something. And likewise, blockchains interact differently. Data is different depending on what market you work with or what asset class you're working with. So some form of standardization is necessary. For example, whenever we built our solutions, we decided let's work on EVM only chains for now because this is the most popular. Let's use a token standard. We could have created our own, but we use like a 3643 standard, which, is pretty familiar across the market for real world assets, because this is what we think, you need: standardization and integration. And, the two need to be together. They're not exclusive. But when it comes to that, once you have that sort of foundation laid down, just even the starting point, if you want to retailize private markets, you've got a ton of individual investors that want to get access here. What does that mean? More AML, more KYC on a more frequent basis. So even getting digital identities and getting that stuff put together, being able to automate KYC and onboarding for these investors, it's the first problem that we tackled as well. Because what I noticed from past life is typically what you'll do is push all the reliance onto the banks that hold the clients at the minute. It's not a foregone conclusion that banks will always hold these clients. There might be new destinations or new pathways as the financial market structure updates itself. So you're going to need a way to automate all that onboarding and make it trustworthy. Even when we had hundreds, let's say, of individuals coming into a private fund of ours for retail, just even getting that annual update was so time consuming for compliance representatives, sales representatives, etc. So taking that away, automating it, and being able to give someone a digital identity that says all the credentials, like the PI isn't going on chain. There's nothing public there that should be private, but you're able to say this account held by Pat O'Meara. We don't know who is behind the account, but he's an accredited investor. He's based in the US. He can invest in all these products, etc. The data is standardized, so any manager, whatever, can tap into that data, trust that you have been AML KYC'd, and you're able to start investing into certain products that you're eligible for. Whereas today, that's a completely manual process. You want to go from one fund to another. You're dealing with another administrator providing the same documents. You're going to get that year on year with the different administrators looking to update your KYC AML. It's just really inefficient, time consuming, and it's a lot of human hours that are wasted, in my opinion.
And brains that are wasted, right?
Yeah,
Mind numbing function of 10-finger automation, right? We used to call certain desks that on trading floors, monkeys with leather lunch boxes, right? Because they were repricing low floaters every day, right? Like the most mind-numbingly dumb thing in the world, right? Mm-hmm. Hey, Tony, tell me about golf for 15 minutes. Will you take this price? Yes, I will. Okay, right? That's something that totally should be automated. Do you know what I mean? Now, the problem is it's already a hugely efficient market and there's not much to be done there. But when we start talking about bid-ask spreads between good data and bad data that are 30% or 20%, right? All of a sudden you go, oh, there's a business to be made in there, right? By really getting this more efficient. And it really creates an opportunity, Albert, for us to say, as we look at the data, being able to be processed and at scale and at speed, there is a mechanism for not just efficiency, but paradigm shifting, right? And I'll because people say, well, why do you, Stephen, why do you make the comment? I'm going to throw this back to you, Albert, in a second, but just to tee it up a little bit more, Stephen, you made the comment, blockchain will be there inevitably. Why? Well, just at the basic level of currency, right? We can look at what happens when a currency is so abused in Venezuela and in Nigeria and in Zimbabwe, right? Where all of a sudden Bitcoin becomes the native element by which commerce is done 24/7, 365, because the normal way, regular way blew up, right? And what we're doing is we're saying, gosh, those efficiencies on how that money's moving, it is apparent and obvious to everyone. It is the stringing these elements together, right? That you just go, wow, this is the promise that's happening. And if we can take that data, make it better, make it trusted, and have context, not only can we process it better, but we can correlate it better. And I think that that's a big piece, right? How this asset trades compared to a data point I'm seeing in the marketplace, right? And these new tools that are going to make things that aren't even possible to be done, being done. So talk to us about how structuring our data correctly and making it available to all these big new tools, is it going to create a new paradigm, or is it just going to drive much more efficiency?
I think it will. And, the reason the problems exist today is simply because everything's in a black box and siloed. The inherent characteristics of using the blockchain technology, whether that's like a permissioned public chain or a private permission chain, or a permissionless public chain, whatever you might have, it's transparent and it's trustless. So that once you've got that structured data and it's on a platform then that is transparent and trustless, other providers can tap into that network and use that data. Whereas today, you're going across a whole web of different types of data. You don't know if you can trust it or not. You're having to do your own due diligence on it. It just creates so many more inefficiencies. So by, trying to erode those inefficiencies away, you've got a completely, as you said, paradigm shift to something new with a lot more possibilities. And as the technology, advances with regards to AI, there's a ton more, it sounds like really like, too future thinking, in my opinion, so I won't dive into it. But there's a ton more applications that can be brought about by having this structured data and having it on chain.
Albert, let me, I asked like a 45-minute question, which is not all that helpful, but I'd love for you just to weigh in.
Yeah, I'll take a crack at it. I think I know where you're headed. So you have these companies with a bunch of data that they process very slowly, very inefficiently. They usually don't know where it is, who's supposed to do what with it. They're sending copies of Excel files back and forth to each other. No one's sure what's the most recent, most correct. They have to ask, double check, all these things. And then you have people manually moving stuff from one Excel sheet to another. That's my favorite one. And then you have all these exciting AI tools that are out there and seem very promising and can do some very impressive things. And then when they interact with each other, it's like, well, how can we use these amazing tools? And the AI companies are like, oh, it's easy. You just give us a copy of all of your data. We'll train a custom model. So already we're in fantasy land because that's not happening. And it'll be great, except it'll be a black box. So you won't know why the AI made the recommendation or decision it made. And by the way, sometimes it'll make stuff up. I hope that's okay. And you'll have really no way to tell. All of that is a deal breaker. And then you have the thing on top of it where there's almost always another party involved in your transaction, a buyer, a seller, an appraiser, a regulator, somebody who would need visibility on certain things and certain data fields, requirements, audit trails, to be able to even let you do the deal in the first place. So you have all these problems, and the question becomes, what do you do about it? That's something that Invenium's been working on for years now and is helping clients solve every single day. And the amazing thing about it, as it turns out, just from a base technology standpoint, it turns out that the same way that cloud computing revolutionized the way that you share data amongst people you trust, blockchain is the perfect mechanism to create an environment where you don't have to trust. You can verify, and you can verify without creating new copies of data, without sending data from one place to another, without changing it really at all. You can use the blockchain to basically anchor yourself to reality all along the way, and then scale that infinitely because it's unbreakable. And that's the amazing thing. It's like going to the US Mint, and instead of stealing a bunch of $100 bills, you steal the mold or the printing plate for the $100 bill. And that's really what Invenium allows you to do.
And I think that the opportunities here for us trusting data from the edge, pulling it into these models, into these AVMs, into these automated waterfall calculations, we're going to see them being done. Different people are going to oversee their different models, but what we're going to see is the ability to provide proof of origin and proof of process of data. And if we, in order to recreate the calculation, to recreate that the AI is doing it, or one AI is checking on another, right? And we're going to be able to say, yep, we ran this 100 times, we got the same answer 100 times, and it's right? And if we do it manually, it'll come out with the same answer. And the problem with this is when you get too much compute, where you do not have that attribution to source data. I want to go back to the Wells Fargo case, right, where Wells Fargo was, had the $3 billion fine, right, because they were their mortgage origination was automating the acceptance or rejection of an applicant. And what was happening is it was deemed racist because it was, certain sections of the city that were predominantly one race or another were getting, much higher rejections or acceptance rates than would make sense, when you just look at it plainly. And the judge said, listen, you built this huge model, you've outsourced, you've gotten away with your whole business departments that do mortgages in the state of California. That's fine. Come to me with a mechanism to show me why your machine, your black box, is accepting or rejecting. They couldn't recreate it. And a year later, they came back and they told the judge, we can't do it. And the judge said, no problem. $3.5 billion. Here is your fine. And so Wells Fargo either had to get out of the mortgage business in California, or they had to pay the fine and start to do this. And what that scared that everybody, right? Everybody got scared to death of, don't use automation until I can provide attribution. And that's what Invenium is doing, where we're partnering with people like Hedgehog. We're automating the function of the administration of these assets, turning these assets into something that are done, partnering with people like Houlihan Lokey, where you can say, this automation makes it easier for me to source, so I don't have to go back to my files and keep it, and doing this. And it really is interesting because AI, Albert and I were visiting the offices of an AI company that was advanced artificial intelligence utilization in the administration of assets. And so what they were doing? A person was doing it manually, and a person was doing, and they were doing it with AI. And if it matched, that was great. And if it didn't match, they'd have another person do it. So they had 4 eyes principle, touching it. And so it was like a 25% savings, not even a 50% savings. And they're not really using AI because they can't recreate the calculations. And they knew the hallucination was large enough. And this is where we need blockchain to provide the context of we're only using good data, right? And I think that this is going to open up the doors. And I really want to go talk about what is this going to deliver to us down the road. David, when we think about who's going to use this, right, why are they going to use this, and why do they want to use this, and why do they want to help drive the creation of these microprocesses that can be just done a ton?
Well, let me say I wanted to catch up on 3 things. First, Albert, you referenced dinosaurs, And yes, I come from, I work in Jurassic Park. I mean, we are full of Tyrannosaurus Rexes who are thriving, but some of them do see that their food source is depleting. And they see that there's going to be a fundamental change. They're not looking up at the comet quite, but they know something's going on. So that world is starting to recognize, and it's really one of the things that makes my job interesting, is that I'm part of that change. But the idea, Pat, that regulators and auditors would rather hear an amorphous, highly biased decision from an individual versus a machine which has a algorithmic, explanatory, and ultimately stochastically predictable answer, well, that's crazy. However, that if you can't document that stochastic answer, well, then you got to go back to the biased people, and that has to break, and that has to break because the volume, the scale of the assets, and the variability of the inputs of every one of those assets are so big. All you're going to get is this huge amount of human bias, which we really have now. And when I walk around my shop sometimes and I say, how did you value that thing and why, to try to understand where our models are going, I get different answers from different people, quite frankly, and that's inside one shop. So I know that first, a well-documented machine is much more preferable to all of the control, the secondary line of defense functions, than a bunch of humans making decisions. But what I also know is this word, variance or covariance, however you want to think about it. But I think of covariance and say, well, once I actually know EBITDA trends for all these companies, once I know fixed charge coverage for all these companies, once I can compare multiples across different metrics than just are they an annual recurring revenue company or something, once I can get deeper in all of these metrics, I build these huge covariance matrices that allow me to predict an accurate spread or multiple for valuation. Once I do that, I've got a huge automated engine. I've got a world, a matrixed world, where I can accurately and in a documented way say why I've got a price. And then I can feed in public market information just as easily. The swaption world, which I used to be in, had this exact same problem. We looked at volatilities. We looked at volatilities from futures markets, and then we finally figured out that the volatilities of swaptions look like a surface. The traders are making a lot of money on these different points on the surface, and then we ultimately simply got together and gave our surface points to each other so we could accurately price the market. And that was so we collected raw trading data in a survey format. Well, I think in private markets that's going to be way harder. The points aren't standardized, but people have to. GPs in particular are going to have to be ready to say, if I want to retailize, if I want to increase AUM, I have to give up this information because it's the only way to get the scale. But at the same time, it makes every one of our jobs, Stephen, your jobs, some of these other fund administrators, we get to a place where we can predictively, because of demonstrable covariance, say that's the asset price. And that becomes, Pat, to your point, real time. So,
but can I tell you, if we wait for altruism to break out, we're never going to get there. We have to incentivize that in a data marketplace. That by the way, Snowflake did an amazing job of creating an incentivization for sharing of data. The only problem with how Snowflake did it is that they needed to keep a copy of every version, right? And when they did that, that created the ability for somebody to hack them, and everybody lost all their data, right? That's one of the big problems with all these strings company, right? That they have that they're saying, oh, for us to process this data, we need all of your data, and we're going to keep a copy of it. And everybody's saying, that is a Web 2.0 solution that will never win, right? And what we need to understand is it is this next generation, and it's going to open up doors for how this is going to work. And Stephen, when you guys at Hedgehog, when you think about who the ideal user and what this is going to open up, let's talk about who are those people, right? That you just go, oh, this guy is going to be an early adopter, right? They are the exact right person who's going to do this. And then what are the functions that you're going to automate that are going to create the greatest value the quickest?
Yeah, so even just touching upon your point about the data there now as well, like who's the users that we should target at the start? We went through this sort of song and dance a lot at the very start because we were talking to big PE houses, big distribution partners, and we knew from the start, even from my past experience, the distribution partners do not want the PE houses to have the underlying data and information on their underlying clients. Why? Because then they can just undercut them, like, their business models disrupted like that once they lose that sort of data. So we've actually, worked and structured a way. I don't think it's going to be binary where it's going to be like, one day everything will be on chain and it's altruistic, whatever. It's like a salami cutting approach where it just goes bit by bit. So the ones that you're going to look for, it's not going to, I can't see it being the massive, broker dealers that you have in the US or the massive distribution houses. It's probably going to be the medium-sized ones or the ones that are more like, open to this technological adoption and taking on a bit more of that risk to move and drive the market in that and try and be a first mover and get that first mover advantage. And this is what we've tried to also build our systems around as well, that using zero knowledge proofs or looking at these different sort of options with blockchain, that you can get that trustless verifiable data on chain, but it doesn't necessarily reveal everything just now. Like, I think in the future it does require a lot more transparency in order to really unlock all the mechanisms that we want to within the administration sphere. But like anything, when it comes to automation or adoption of new technologies, I don't think it's going to be binary where one day, with these processes we're talking about right now in the administration sphere, everything's manual. I don't think talking about it going automated is just a flick of the switch. You sort of have the human stabilizers on that the entire way as well to check, make sure that the automation is working for a certain amount of time. And you get that human feedback as well before you decide maybe, you can take the hands off the steering wheel. But yeah, that's sort of the way I feel it goes.
Yeah, anybody who's ever driven a Tesla, right? The first time you drive it, your hands are right next to the wheel on the auto drive, right? You're right there, and then over time, right? Albert's playing Sudoku, and as he trusts Tesla to take him. But the reality is it is going to take a minute for people to build in trust and then perfect it and iterate and iterate and iterate and iterate until we come upon the right structure with the right checks and balances and we get there. But it's coming. And I want to talk about, in my opinion, one of the early users. We've talked to a number of the big pension plans in the US. These are defined benefit plans. And two things are happening. One, they're afraid of lawsuits. There was an Intel lawsuit about, in defined contributions, you need to include these alternative opportunities, right? Because even though there's no reason people weren't, other than structural and legal, right, that you wouldn't include them in there. But all of the older employees who are the higher paid employees because they've been there longer, right, are in defined benefit plans and defined contribution plans didn't have access because there wasn't daily marks. And the defined contribution plans want to offer unitized versions of their pool of funds because A, it outperforms what's offered in the defined contributions. That's one. But two, if they don't, they're going to be out of a job in 25 years because they're not going to be managing any money because everybody, all of their participants are going to be full on retirees and they're not going to have any money and they're going to be managing a dwindling asset pool. They want to maintain a mechanism for, pick any of the big states that they, in their, let's just talk real estate alone, they're outperforming what they offer to their defined contributions on those real world assets or real estate assets by hundreds of basis points. You know what I mean? And the problem is they need to unitize, they need a mark every day, and they need a mechanism to deliver it into that defined contribution. And we're finding a lot of uptake in that, right? Helping these big pension plans get there. And Albert, when we're talking to a number of the biggest sovereign wealth funds in the world right now, right? Talking to them about these projects, about how do they manage their data better every day. Even though they're not worried about retailization, they want professionalization of that administration, right? Of their own assets, right? They want to manage their own portfolio, right? And create indices, right? So LPs can compare performance of GPs against that are real. Talk a little bit about that, right? How is this valuable to the biggest of the big asset managers, not just on this retailization?
So that's a great question. A pretty simple answer. They want to have the truth faster, and they want to know that it's true more quickly. And one of the things that made our technical architecture more challenging from the beginning was that it is decentralized and it's nearly infinitely customizable. Most technology companies do the thing where they force the client or the user to adapt their business to the technology. We took the exact opposite approach, and that was more challenging at the beginning. But what that accepted was the reality that no two processes are the same. You're never going to fit a square peg into a round hole, and you're just asking your users and your clients to accept a loss in functionality, a loss in efficiency, or just throwing out some mechanism of their processes just to fit your technology. And so, the decentralized architecture, the guardrails to enable automation, all of that allows a large scale enterprise to figure out what is going on with their assets more quickly than they otherwise would, without sending it, for 4 months to an auditor so that they can get the answer back.
And this gets to a very real issue, right, David, that the market is always efficient except when it's not, right? And there are times when there's a market dislocation, and that price is not representative of an orderly market. It's representative of a dislocation that truly will go away in 2 to 3 weeks or 3 months. You know what I mean? Yeah. And what do I need to do to hold my asset to maturity or whatever, so I don't create an artificial accounting crisis? Does that make sense? But it's not a crisis of the asset, right? The asset's performing perfectly, et cetera, and the market dislocates, the asset hasn't broken, right? And this is the challenge of, this is why people like private assets, but it's also why they don't want too much, because they want the truth faster most of the time, right? 98% of the time, that's what they want. That 2%, right, we're not so much. And that gets into your question that you talked about, the conversation in the water cooler, right, that from Monday.
Yes. Yeah, well, I guess people think the 98% is the truth. The 2% is a lie. Well, 2% was a lie, except for the fact that it transacted 100 million times. But so yes, bridging that can be very difficult. And I think one of the market disciplines around that is the amount of leverage and the way the leverage mechanisms work. When you've got these public market leverage mechanisms that use the price and then have margin calls same day, well, that's a fast cycle of discipline. I think the private markets do have the advantage, and an appropriate advantage, when that cycle of discipline has a little bit more time. I mean, think about it. We used to have, we still do, we have circuit breakers in public markets for exactly that reason. Like, okay, let's take this human dynamic of panic a little bit out of pricing. And you would think that in these private markets, essentially we can, Albert, you can negotiate some of these parties to a place where we would get better liquidity, but without margin calls for the 2% situations. Like, can we stay out of the tails of these swings when we have margins? And I think that stuff you can start. That's the conversation that's going to happen to get GPs to open up. They'll open up the information as long as somehow we can show them a world where you're not going to get margin called and have that 2008 downward correlation of 1 spiral when you get some kind of panic event going on in the markets, because that's really
I don't
the
even
biggest,
think it's not even the 2008 correlation of 1. It was the Monday correlation of 1,
yes.
right? Right.
Yeah.
Where the Bitcoin and the gold and everything, right? It was a correlation of 1, right?
Yes, and so Albert, you've got to start negotiating that between some of these big guys. Maybe there's a consortium that everybody gets a little scared. They want to get together and make a step-by-step approach, right? If you can come up with the top 6 asset managers, and I think they're actually starting to do this. They're starting to look and say, how can we team up a little bit? Because obviously it's control, right? How can we team up, have a limited amount of control, define the standards by which we'll start giving out more information? And you need a control mechanism or an intermediary, and Invenium's a very good one because it's got the trustless characteristic. It's got the data at the edge.
It's the best one.
Yeah, the best one. So the GPs like all of that. I like that as a valuation agent because I get trustable data and I can increase my velocity. And by the way, we're not just a valuation agent. We like the fact that we can use all of this frequent valuation information to inform our capital markets and corporate finance businesses. I mean, fundamentally, that gives us a great advantage, particularly in the middle market where you can't tell prices of anything accurately. So our capital markets and our corporate finance people very much like the idea of frequency of accurate, trustable information. They just can't pry it out of the GPs. So if we could all pry it out of the GPs a little bit faster, and do it with this incentive that
or
says
impose it on the GPs, maybe against their will, right? And that's the issue, Stephen.
Well, the SEC might do that.
I was just going to say, didn't the SEC try and fail to do that? I actually look at as much as I sort of like a bit of not like deregulation, I would say, like not having full on regulation. I still think it's important to go top down and bottom up as well. So incentivize those GPs to provide that data, show them the benefits and maybe the light in the future of that increased AUM, transactability of their assets, etc. But also from the top down, regulators actually really need to start understanding private markets a lot better, how it works, its operations. It's clear that they don't to the same extent as public markets, etc. And then impose that and say, these are the reporting standards that you need to do. This is the frequency. This is the data that you need to provide, especially if you want to start touching, retail money, because that's the, more vulnerable money, let's say. They don't have that institutional sort of background to understand the tax.
They don't have the sophistication, right?
Yeah.
And that standard has fallen because of general price inflation of things, right? That accreditation standard is way lower than it used to be because it hasn't changed nominally.
Yeah.
Yeah, absolutely. And what we see is the shrinkage of the public markets, not by size, but by numbers, right? Like the number of people who that are public is just shrinking and shrinking and shrinking. And what we have to do is bring the discipline of data and the automation to bring the types of liquidity and the type of cap rates. So there is a stepping stair. It's not a cliff. It's a staircase that with better data and with better mechanisms and better structuring, we can get to these stairs where we say, I don't want to disclose anything and it's going to be locked up for 10 years. I'm going to be forced to give you this higher rate of return. Well, I'm going to give you these mechanisms to get out more frequently and better data, but I'm going to give you a lower rate of return, right? And you look at this, the public markets, lowest cost of capital in the world, bar none, but there's obligations for that, right? And I think what we're doing is creating that stair step. Let's go, and then we're creating opportunities for that with the new technologies. I'm going to go around with kind of our last comments for everybody. David, I'd like you to go first. Comment on anything you want, and I'll give you a sample question as well, which is when will retailization happen, or make any other comment you want.
Yeah, fine. Retailization is happening. If you look at public market BDCs versus private credit, LP interest, the two do exist. And well, the problem is that no one has a good way of comparing those two results yet. Over time, we're going to start to see that, and you'll see some differences for the liquidity characteristics of the two vehicles. I don't think that'll be enough to force sort of broad scale acceptance. But I think fundamentally it's greed around scale that's going to drive. And when you look at some of the big asset managers, particularly the ones that own insurance companies, that's scale. They really need that, and they need to be able to continue to acquire assets that they can trust, because they'll get to I forget. I think it was Peter Lynch in Fidelity, right? Who used to say, "I'm so big I can't buy anything anymore." And they're going to get to the same place. They got to be able to trust what they're buying. And trust that the pricing on it gives them real information.
We're going to say that wasn't really a lightning round answer. That was more a thunderclap answer. We got to keep moving. Stephen, any comments?
Yeah, so just on the retailization, definitely it's underway. There's been managers trying to attack it for ages. Now there's regulatory structures in there. And I think at the very start of this call, we talked about retailization and democratization. And I think I said that, I think there's sort of two distinct elements. I think retailization of private markets is underway. I think the only people that can do it at scale properly, given the complexity and the relationships that's needed, are those large blue chip managers. So I think it's underway. I think it, as a macro trend, this is going to be the next big one. But I think whenever we talk about democratization, it's about getting, all those processes and automation and data on chain. So it's not just those large blue chip managers that can retailize their funds, but it's every sort of private markets manager or institution. So I think those are the two macro trends, and that's how I see them playing out.
Albert, any comments?
Yeah, so to echo the comments made already, this is already happening. Unfortunately, for confidentiality reasons, I can't call out specific clients that are doing it. But if you're watching this and this sounds very interesting to you and your enterprise is not yet using Invenium, it's very likely that your competitors are. So I encourage you to reach out to us.
Yeah, and I want to say, Stephen, you made the comment. In fact, the blue chips are the ones who are going to do it. But the cautionary tale is we have a couple of American astronauts who are stuck in space, and then they now push the pickup date to the 25th of September in order to give the blue chips the ability to continue to try and get something working that is not working when there's a perfectly viable mechanism that is able to pick them up today that they don't want to use because it hints at the inefficiency of the blue chips. And you're going to have a Robinhood, you're going to have a Coinbase, you're going to have a Binance who's going to race up there, and they're going to be the SpaceX to, and I don't want to knock the Starliner, but you know what I mean. There's going to be both, but there's going to be some innovators who move far ahead because they're not constrained by the legacy.
Yep.
Right. And that's a fact.
Exactly.
Yeah. All right, guys. Thanks so much for joining us. David, any last comment that you wanted to add?
No, thanks. Yeah, you shut me down. I'm good.
All right. God bless you guys. Thanks, everybody. Thanks for listening.
All the best. Goodbye.
Bye.